Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is VideoCast episode 90 and podcast episode 80 for the week ending Thursday, July 8th, 2021. And kick things off, we got back from Florida finally early Thursday morning. Although it's no different, I work the same when I'm traveling and when I'm away. But over the weekend, we did 3 days at Disney with the girls, had a great time. Couple photos there. That's at Animal Kingdom. That one is at Magic Kingdom. They painted the castle a different color. I forget why, but anyway, it doesn't look as good as it used to, but I think they'll change it back. And then this was Hollywood Studios with the Hollywood Tower of Terror. If you ever get a chance to do that, definitely take advantage. They basically drop you 5 stories in an elevator and scare your kids, which is always fun. And then this, I guess, was also Hollywood Studios. So, interestingly enough, there was a ride in Hollywood Studios. It's like this Aerosmith roller coaster, and out of the gate, you go 0 to 60 in 2.8 seconds, which, if I'm not mistaken, that is the same speed as the Tesla Plaid. And when you come out of the ride, they snap your picture as you're going, I guess, super fast, really, really quick, which my 7-year-old didn't mind because in the pictures, she was smiling and I looked like a scared little child. So, for a guy who loves speed, that was a serious fast out of the gate roller coaster, 0 to 60 in 2.8 seconds. And I have to rethink because I've had cars that go 0 to 60 in 4 seconds, but, or 4.4 seconds, but 2.8, not sure that's necessary, but I wouldn't mind trying it again. So that's that, but let's get down. Also want to congratulate Tampa Bay Lightning for repeating the Stanley Cup championships. And we got to go last Tuesday. I shared with you last week, or was it Tuesday or Wednesday, to Game 2. And it was nice to see Andrei Vasilevsky get the Conn Smythe Trophy as MVP, which he certainly earned it. The first few games of the series, they were outshot and they still won. Tampa Bay did. So huge kudos there. And it was nice to see that last night, albeit it was on TV from Connecticut. It was still good to see the progression and the win. Moving right along, on Friday, after last week's podcast, I was on the Claiming Countdown on Fox Business with Lauren Simonetti. Thanks for having me on. And Ellie Terrett, thank you for having me on. And the basis of this segment was to talk about the jobs report and to talk about the trade. And we're going to get into that in our article of the week. So hang tight for that. Also want to thank Devik Jain and Amber Warwick for quoting me in their article in Reuters this morning. Everyone knows the market was down huge. The futures closed down weak, but with some more strength than it had in the morning. And I said, what you saw with Didi this week really spooked investors because you have a concern now that we don't know what the regulatory proposals are going to look like. Until there's clarity and the Chinese government moderates its stance, investors will dump holdings and ask questions later. And we saw that this week. And we're going to talk about how we're thinking about that and what opportunity it may represent for us to take advantage of, which we have been taking advantage of. And I think these are some appropriate quotes to set up the context of today's call. Benjamin Graham said, individuals who cannot master their emotions are ill-suited to profit from the investment process. And this game is 80% mental and 20% technical, understanding what to do. Understanding what to do is in every textbook under the sun. You can read Benjamin Graham's Intelligent Investor, Security Analysis. You can read the CFA books. But when push comes to shove, why isn't every CFA a billionaire? And the answer is because it comes down to temperament, risk capacity, knowing what you own, etc. And we're going to drill down into some of that, particularly as it relates to Baba on this week's call. And this second quote from Philip Fisher, he says, the market is filled with individuals who know the price of everything but the value of nothing. And I think that holds true, especially this week, as it relates to Baba and some of the other stocks we're going to talk about, because nothing changed fundamentally. We'll talk about the regulatory noise and the Chinese government errors, but the underlying business did not change, and all that changed was the emotion around it, panic selling, uncertainty, and this is where Warren Buffett talks about great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock market to be misappraised. And this week is a perfect example of that. Investors' perception of the Chinese government's moves and the reality of the government's moves, which we're going to try to dissect. But if you think about excellent companies, and if you were to ask 10 intelligent investors on the institutional investors, what's the best company to own in China, I think 9 out of 10 would say Alibaba, and yet it's trading at a 30-40% discount to its intrinsic value on growing earnings and growing top line, growing bottom line, everything else, just because of some short-term noise. So it leads me to we're going to do the 3 questions of the week, but the first question of the week was here we go. Okay, Surya Shah says, "Hi, I'm very much impressed by your podcast and the service you're providing for small investors. Unfortunately, I did not buy some shares in Alibaba even though you were pounding on it. Should I wait for some pullback as it has risen quite a bit since your recommendation, or is it still okay to buy for the long term? I really appreciate your input. You're the best. Thanks." Well, this is the beauty of markets, is that everyone wants to buy on a pullback until they actually get the pullback. So, Surya, I don't know if you're out there, but we were in the market today aggressively adding to Alibaba. Is today the bottom? I have no idea, but all I know is I have a rough idea of where the intrinsic value of Alibaba is, and I think over time it's well north of 300. Whether it takes 6 months to get there, or 18 months, or 36 months, I don't have the answer to that question. But my presumption is after this short-term smoke clears, I think you could see it recover to in that ballpark over the next year or so, and that's going to dramatically outperform the S&P 500, because from 200, our basis is 211. It lowered today to whatever it lowered because we bought below 200, but that's going to be at least a 50% move, and then we have some long dated options as well to add some alpha. So if we're right about our outlook on intrinsic value over the next 6 to 18 months, that major position in the portfolio is going to yield probably notionally about 70, 75, 80% on the total amount of capital at risk. So we like that risk reward. And if it goes lower, we'll probably add a little bit more. And so that's that. So let's talk about it, because the second question was basically the same thing, but this was from first name only Blake. Hi, Tom. First off, love your show and appreciate all the insight you give to listeners. As someone who wants to get into the industry, your podcast has been an incredible tool to supplement my learning. I have a question for the Ask Me Anything segment of your podcast. I'm sure you've gotten this question a lot, but feel it's relevant with the news from China this week, with Chinese authorities possibly changing rules, allowing them to block companies from listing overseas. How does that affect tech giants like Tencent and Alibaba that have already IPO'd and sold shares to U.S. investors using the VIE structure? Obviously, we understand the potential impact for pre-IPO tech companies trying to attract foreign capital, but wonder if there's any potential risk here to Tencent, Alibaba, with restrictions potentially being imposed, intensified scrutiny, etc. Great question. We're going to cover that as well, Blake. And then I just want to do the third question, because sometimes if I don't get to them all at once, I forget by the end of the show. So Shaurab Mohammed asks, how are you? Great video cast, extremely informative, and now you gave us the process you go through. FinViz screen for large cap over $2, fantastic as usual. In all the last 3 video casts, you mentioned that the yield sensitive sectors and I researched, understood the defensive sectors and big pharma, but I couldn't understand why the tech sector. So we've been talking about, by the way, and this is a great segue into this podcast, with yields lower, defensives, utilities, staples, and big pharma, as well as tech, would benefit from the moderation of yields, which we thought would persist over the summer. And if you recall, we said several weeks ago we thought yields would be lower in the short term and probably then reverse at some point as we get closer to the end of the year and finish the year, if not just shy of 2%, the 10-year yield, like 190 basis points, if not over 2%. And so far, that's correct. So we are getting the strength in bonds and the weakness in yields we anticipated. When the inflection will be, we don't know. But we are starting to see that second leg bid that we've been waiting for on the staples, some utilities, and pharma. And I think that's going to persist here in coming weeks, which is right on time. So that's great. Now, to answer Sharab's question is... So why is tech involved? So long duration earnings are sensitive to rates as a lower discount rate makes future earnings more valuable today. Higher rates makes those future promised earnings less valuable. So that's why I responded to Sharab. So basically, if rates go up dramatically, the discount rate goes higher, which makes the value of the future cash flows, net present value, less valuable in the present day. So in a declining rate environment, as you saw from basically the last crisis till now, tech outperformed because those long duration earnings for companies that either had no earnings and were promising big earnings 5 years out, or had earnings growth, that becomes way more valuable when the discount rate is low. And with the 10-year now around 130 basis points, never mind below 150, those longer dated earnings become more valuable in the short term as long as rates stay subdued. So that's why that's kind of an outlier non-defensive group that fits into the bucket of beneficiaries to lower rates. Great question and thought process there for Sharab. So, okay, so let's get into the stuff on Alibaba for Blake and for Surya. Okay, so here's an article from Barron's. Beijing's regulatory plans could hurt the U.S. listed Chinese company. The pitfalls investors should know. This is from Barron's later yesterday. So if you look at the Tencents and the JDs and the Babas, they're registered in the Cayman Islands and they use a variable interest entity structure which allows them to get around Chinese restrictions on foreign ownership and capital and currency controls. And this has been used since the year 2000 when a company called Sina, S-I-N-A, went public. They were kind of the pioneers, so to speak, in this place. And what Chinese regulators are mulling is a change that would require companies using this structure to seek Beijing's approval before listing in the U.S., Hong Kong, or elsewhere, something that could hold already listed companies that could hold for all. So basically, how it would impact existing companies that are already public is if they choose to do a secondary offering to raise more capital, they may have to ask Beijing for approval. That's not going to be a major factor with JD or Baba. My sense is with their cash flows, they're more inclined to be buyers of their undervalued stock than sellers of new stock. But certainly you don't want that overhang of having to go beg the government to sell more stock when, if the stock goes up 50% from here or 100% and it's trading at, 40 times forward versus 20 times forward. Are they going to want to sell stock? Well, if I was running it, I certainly would be interested in considering it. So the bigger impact is it's going to make it harder for, potentially make it harder for new companies to go public. Okay, and I think Blake touched on that. So So on the existing companies, the bigger risk is that they can't raise additional capital, or they have to go through a process with the Chinese government, which kind of messes things up in the short term. But I think what you're going to find, and as we drill down later into this call in the article of the week, that what Chinese government has done of late is against their self-interest and ultimately will be unwound. And how we know this is that one of the things that happened this morning is they announced that they were going to loosen monetary policy again. And if you recall, in the past 6 months, pretty much every time I've been on CGTN America, I said that China should not be tightening in the middle of a pandemic. So they did some kind of industrial and construction stimulus early on in the pandemic, and then they started tightening once the Western world announced aggressive fiscal and monetary policy. They basically said, okay, we're going to tighten, we'll just free ride on them and piggyback. And I said explicitly this is a mistake. They should keep the pedal to the metal like the Western world is doing until the pandemic is fully in the rearview mirror. There's no downside to doing so, and there might be tremendous downside if they tighten too early. So that's what we saw. But they adjusted. It's one thing to make mistakes. It's another thing to not correct them. And I think that what we're going to see with their kind of killing their own, that they're going to find that if the global capital markets start to close the door on Chinese companies, their hopes and dreams of becoming, having global economic hegemony will be destroyed immediately if their biggest enterprises aren't able to raise capital. And it's moving in that direction, but I think we're at an acute enough point that it's in their interest to back off. And if they do so at this stage before too much damage is done, then the outlook will be very positive for them. But we'll drill down. The other thing that kind of knocked the market for a loop this morning, obviously the Tokyo Olympics will be held without fans after new COVID-19 state of emergency declared. That's, the Delta variant is getting some traction globally for people that don't have the mRNA vaccines yet, but don't worry, Pfizer and Moderna are going to get them to you, and that will be taken care of in due time. The next few things I want to cover, these are from Ryan Dietrich over at LPL Financial. Let me just see here. Okay, so he has basically just some overviews when the S&P makes 7 consecutive new highs, what happens a month later, 3 months later, 6 months later, and 12 months later. On average, it's up in every single period. So this short-term pullback is in line with what we had expected in the beginning of the year. We thought we were going to get a handful of these shallow pullbacks, 3, 4, 5%, closer to, most of them have been 3% actually up to this point. We've had about 3, so we should expect a few more before the end of the year and finish out the year mid-teens. We may very well finish out high teens since we've already booked 14, 15%. I guess maybe a little less than 14% as of today. But on balance, it just shows an underlying bid in the market, and that persists. What happens after 5 months? The S&P, 5 months of win streaks for the S&P 500, 1 month, 3 months, 6 months, and 12 months. On average, again, it's up in all periods. And 5 quarters of S&P, same thing. A quarter later, 2 quarters later, and 4 quarters later, it's up on average. So good quantitative data from LPL and Ryan Dietrich. Now, a couple other things. Okay. Okay, so the State Council said on Tuesday that rules for overseas listings will be revised while publicly traded firms will be held accountable for keeping their data secure. China will also step up its regulatory oversight for companies trading in offshore markets. So, and under the revised rules, VIEs like Alibaba that have already gone public may need approval for additional share offerings in the offshore market, according to people for Fairly. So they're very worried about their data. They want to put on data controls. That's not new. These companies will comply. They'll share the data that the government wants. and it'll be back to normal. How much they're going to hold back these newer companies from going public, that is a risk. So if you own a lot of private equity in Chinese companies and you're waiting for your big day for them to go public, you may be waiting a little longer, but that's not the neighborhood that we're playing in, so that's not a big thing. The other thing that President Xi has to worry about, Bloomberg put out a great article this week by Eric Zhu and Tom Orlick. When will China rule the world? Maybe never. And it goes through something that I spend a lot of time on these podcasts, which is demographics. And I've laid out the case why the U.S. is in a very constructive demographic period with 72 million millennials, and I'll show you some images on that later in the VideoCast. But China does not share that same demographic tailwind. So the nightmare scenario for President Xi is that China could follow the same trajectory as Japan, which has been kind of my base case. Also touted as a potential challenger to the U.S. before it crashed 3 decades ago, and it's not fully recovered since. A combination of reform failure, international isolation, and financial crisis could halt China before it reaches the top. So basically, what China is doing is if they persist down this road and kill their own by constantly fining and restricting the growth of Alibaba and JD and Tencent, so they can't compete with the likes of Amazon and some of the bigger international players, whereas their growth rates were actually exceeding Amazon's, certainly in terms of Alibaba Cloud, they're going to just fall behind. And that's not the kind of thing that you want if you're a Chinese government official. You want your companies to be the biggest and the best. And that's the trajectory they were on prior to this crackdown. Now, if it's a short-term crackdown and, like they had guidelines for live streaming, you can't be under 16 in live stream. Well, that makes sense. That's a guide rail. You can't make false claims about products that, don't do what they say they do. That's a good thing. That's good for the consumers. That's going to lead to long-term stability. And what we're going to find as we drill a little deeper with the Didi IPO is that Didi may have dug their own grave by disregarding some of the Chinese government requests, multiple requests, I think in the neighborhood of 30 regarding data, and they just pushed out the IPO. So the market may be overreacting because of all the things. The Ant Financial thing got delayed. Jack Ma's disappeared. Baba was fined $2.8 billion, sometime back, which started the weakness in the Chinese stocks, and all of those different things. But the future of China is going to really depend on these platforms becoming bigger and bigger and spurring internal consumption, which is part of their dual circulation plan over the next 5 years. They want to get their consumer going because their growth has been largely driven by manufacturing, construction, and that's where they put their stimulus money because they wanted long-term returns. But the consumer has lagged, and that's partially due to mercurial policy as it related to COVID. One day your business is humming, the next day the whole city is shut down because there are 3 cases. And it creates this stop and start where they've just struggled with momentum. And part of that is because they were also lagging on the vaccinations and they don't have the mRNA, but they do have now quite a few vaccinations of their own vaccines. So that's a positive thing. So what this article is basically saying, obviously they're questioning China's official GDP. I take that with a grain of salt because no one questions their GDP numbers when they were horrible in the acute phases of the pandemic. They only question them when they're good. So I don't think that's a reason to question it. I do think demographics, because they had the one-child rule for so many years, and in 2016 they changed it to 2 children, and now they're trying to catch up. They realize, oh my God, we're gonna wind up like Japan. So now you can have 3 children. And that's one of the components in this article. The three factors that determine the economy's growth rate. The first is the size of the workforce. The second is the capital stock, everything from factories to transport infrastructure and communication networks. Finally, there's productivity, or how effectively those first two can be combined. In each of these areas, China faces an uncertain future. Start with the workforce. The math is straightforward. More workers means more growth. Fewer means less. Here lies China's first challenge. Low fertility, the legacy of the one-child policy, means that China's working-age population has already peaked. If fertility stays low, it's projected to shrink by more than 260 million over the coming 3 decades, a drop of 28%. Aware of the risk, China has changed course. Controls on fertility have been relaxed. 2016 was raised to 2 children. This year announced that 3 are allowed. Meanwhile, plans to increase the retirement age could keep older workers in their jobs for longer. Even if the reforms succeed, it'll be hard for China to offset the impact of the demographic drag, the same one that Japan faced in the late 90s. If you remember, many of you probably don't, but they were buying up Rockefeller Center. They were buying up all the prized properties. And of course, all the American investors were happy to top tick them and just lay off all their product to the Japanese, who were going to take over the world until they absolutely crashed and haven't recovered for 3 years not because they necessarily did anything wrong. The only thing they did wrong was they didn't have enough babies. And we've been able to offset our lower fertility rate through allowing open immigration, which has kept our population growing, which is one of the secret ingredients of the capitalist miracle, basically, is population growth. So rules aren't the only thing that are holding families back from having more children. There's also the high cost of things like housing and education. The reason I haven't bought 3 Rolls Royces is not because the government won't let me, wrote one netizen in response to the 3-child news. Okay, that's funny. The outlook for capital spending isn't quite so bleak. So the main thing is the demographics. And platforms like Alibaba that facilitate internal consumption, which they need to evolve to become a developed market, like the U.S., 70% is the consumer. They're nowhere near that. Alibaba facilitates that. They want to foster growth of Alibaba if they want that too. Is if they do get international coalitions pushing back on trade, they're going to need a stronger domestic economy. Again, Alibaba facilitates that. They're trying to push the digital yuan. Again, Ant Financial facilitates that. So everything the government wants and needs as a hedge, these big platforms provide. What they've been doing is trying to put guide rails in, and it's natural. Usually regulators overshoot in the short term. They come back to the middle, and then everything's better off. You do have rules that are constructive for the long-term growth, and but you don't choke the growth off completely. And if I'm the Chinese government, I'm thinking, the one advantage that we have over Europe is Europe doesn't have any major tech platforms because their regulation has always been too restrictive, and that's held them back, and that's set them behind relative to the U.S., which is just a bastion of innovation. So I think this is going to get resolved quickly, and I think that there will be a bigger screening for new IPOs, but the bigger platforms are already been in that compliance process with the government. Now the market just needs to get comfortable that this is the extent of it. As we say, it's always darkest before dawn, before they can start to put money back to work. On the flip side, if the government continues to push on a string and hurt themselves and hurt their biggest, most profitable enterprises and biggest hope for the future, both domestically and in terms of international growth, then they'll just leave themselves in the dust, and the rest of the world will out-compete them and out-innovate them and outgrow them if regulation becomes too stringent or if capital flees. Look, capital goes where it's treated best. And if the government starts to disrespect the capital that's been afforded to it and its enterprises, which create tens of thousands, if not millions of jobs, which keeps the populace stable and keeps the government in power, then that capital will go away, and so will the stability, and so will the jobs, and so will the perceived power in the region. So, this is a calculus that I'm sure they're fully aware of, and they may be coming to grips with the fact that they're overshooting in the short term, and that did come to bear this morning. And this was something that I tweeted out that wasn't picked up on many of the carriers, but Reuters put it out. And what it said was, okay, the CAC, which is the domestic regulator that Cyberspace Administration of China, that started in 2014 by President Xi Jinping, implements online censorship that has dramatically tightened under his tenure. And the agency champions Beijing's policy of internet sovereignty that keeps China's massive online ecosystem behind the country's Great Firewall. So this is the regulator that accused Didi of illegally collecting users' personal data and called for Didi to stop accepting new users in China, saying that Didi's app had serious violations of laws and regulations pertaining to the collection of personal information. Now, if you actually dig a little deeper, there was an article that came out midday today in the Financial Times that said Beijing asked Didi to change their mapping function over security spheres before the IPO and requested multiple changes to the mapping function of ride-hailing group Didi's app before its listing, fearing it could reveal sensitive government locations, according to two people familiar with the company. The CAC, Cyberspace Administration of China, frequently communicated with Didi, making more than 20 requests for changes to the app, which Didi implemented, said one of the people familiar with the matter. The CAC did not think the mobile app changes. The CAC did not link the mobile app changes to any request to delay the international public offering, said Didi. The CAC has issued many rectification notices to companies without taking their apps down. So, this is kind of a communication thing. Obviously, these companies are going to comply, and it will be back to normal and a rebuilding process, and the markets will rebuild trust, blah, blah, blah. But today it was interesting because I said they're going to have to walk this back or the capital markets are going to just close on their head. And once it closes, it takes years to reopen. And this guy who runs the spokesperson for the CAC came out this morning and said, quote, so we are at a point where the stars are aligned. Oh, no. Okay, that's not the quote. Where is the quote? Here it is. Okay, asked about the CAC's recent action, Foreign Ministry spokesman Wang Wenbin said authorities manage and make safety checks on internet platforms to mitigate risk and safeguard national security. So I guess their fear was that, this map on Didi's, Uber app, basically, would show sensitive Chinese sites that I guess they didn't want foreign governments to have access to, etc. So he says, quote, China's policy remains unchanged. So if the market believed that, all these stocks would have been bid today. So now they're starting with the words. Let's see if they follow through with the action so the market can believe what they're saying. China's policy remains unchanged. We continue to open up and support the development of internet platforms, and we will continue to encourage Chinese companies to engage in international exchanges and cooperation, he said. So this is the key quote. So they realized probably they went too far, capital's fleeing, projects are getting shut down, IPOs are getting shelved, which basically means all these companies are going to do what? They're going to lay off Chinese workers, which are the source of the Chinese government's power. So if you get people unemployed due to bad policy that causes capital to flee, you lose your grip on power. That is a bad move if you want to keep the Chinese government initiatives moving forward for growth and increased competitiveness on a global scale. They probably realize that this is the first reversal in language. Now we get to see if we're going to see some follow through with reversal in actions, which helps them, which helps everyone. So that was that. I guess the takeaway here is Didi obviously probably has some fault here for forcing it out, and probably not a good idea to force it out at the same time the communists are, celebrating their 100-year birthday. Probably wait a couple weeks before you push something out like that, especially such a big marquee thing. I mean, Didi has a monopoly on ride sharing in China. I mean, it's like if Uber were to knock out Lyft and all taxi cabs, that's Didi. It's a pretty interesting platform. So to push that out, wrong time. They should have learned a little bit from Jack Ma. They didn't. So we got to deal with this short term. But that created an opportunity for us. So, I think we've adequately addressed Blake's questions and Surya's questions. And what I actually said to Surya privately was, look, I don't know where the next $5 or $10 is up or down, because it had, rallied from 211 to 229 or whatever it was. And I said, they're probably going to pull back and consolidate a little bit. On last week's call, if you remember, I said that both about Baba and about Splunk, because they had such big moves so quickly from where we were suggesting them several weeks ago. And, it certainly pulled back more than anticipated based on this news, but that also created an opportunity. But I also said, so the answer to your question is, we've just had a huge move, do a little and then, add more if it goes against you, and kind of average into your position. And hopefully, she's been able to take advantage of that. And by the way, you see the terms on hedgefundtips.com right here. This is not investment advice. This is my opinion. So I don't know what Surya's situation is. You have to do what's right for you. Talk to your financial advisor, etc. I deal with accredited investors that are accustomed to risk and reward. And by the way, I think the other thing that has kind of separated Warren Buffett from the rest of the pack, and we've covered this in recent weeks, he's still the richest guy in the world. He just gave away half of his money. So, he's worth north of $100 billion, but he gave away half of his stock over the last handful of years, whatever it's been. So, his wealth would be well over 200 billion right now. And, he's been coasting for a number of years. So, leaving that aside, the point that I'm making is that volatility does not equal risk. If you take one thing away from this call, that's probably the most important thing. Volatility does not equal risk. If anything, volatility equals opportunity. And far too often people equate, like, they look at Sharpe ratios and they, want to know what you're up and down on a week by week and month by month. You will never outperform if you don't have volatility, because by definition, in order to get alpha, you're taking advantage of dislocation. And dislocation is when there's wholesale puking and overshot. If you're going long, overshoots to the downside, or dramatic overshoots to the upside. If you're going short, it's never a wise idea to get aggressively short at the beginning of a new business cycle, which is why we've had, much less short exposure than historically in the last year and a half. But volatility is what leads to the outsized gains over time in a portfolio. And the whole key, getting back to the Philip Fisher quote, with people who know the price of everything and the value of nothing has changed in the underlying fundamentals of Alibaba in the past four months, since, by the way, Charlie Munger made it his number one position in the Daily Journal portfolio, 20% of the portfolio, at much higher prices. And he's still buying it at a discount, and we're buying at an enormous discount to him. And the key is their cloud business. Ali Cloud is growing faster than AWS and could be bigger than AWS in the next 3 to 5 years if they continue with their international expansion and if their government doesn't get in the way. Their Tmall numbers, their gross merchandise value, everything is in place. And basically you're getting the same business, well, now you can buy it cheaper than you could buy it 3 years ago at this time in June, July. You can buy it cheaper at that price. The difference is revenues, cash flow, and earnings per share have all doubled over that period and are going to continue to grow over the next 3 to 5 years, if not more so, because the government is committed to internal consumption. And after this hiccup, they're going to be promoting policies that benefit these platforms. Why? Because it's in their interest. That's why. It gives them more power. It gives China more growth. It gives them more jobs, more stability, more internal consumption, all the things that are required to retain control. Inside of that, Alibaba actually got an upgrade from KeyBank analyst Hans Chung. Maintained the overweight, and his thesis is, despite lower expectations, Chung says Alibaba's market position remains strong among peers in the aftermath of the anti-monopoly crackdown in China, as per the analyst. And by the way, all these regulatory crackdowns, whenever the government gets involved, the big get bigger and the small can't pay for the regulation. So effectively, the net effect of what happens when the government cracks down on all these rules is the small people can't afford to comply. It deters new entrants to the marketplace. The bigger people can spend the money on the compliance with the new regulations, and it builds their moat bigger and bigger as competition goes by the wayside because they can't afford to comply. So the same thing is happening to Alibaba. The same thing will happen in the United States. And when's the last time you saw a new social network pop up? So as per the analyst, with higher average revenue per user and membership adoption, Alibaba's business-to-consumer online retail platform Tmall has boosted its market position in the mid to high end of the online retail market. On AliCloud, which is turning into a bigger source of revenue, Chung said the unit continues to see strong momentum in the enterprise and the public sector. The analyst said Alibaba's management tone indicates better landscape dynamics than feared by Wall Street. So the lower price target, so their target is $270, which would be 35% move from here. Lower revenue, operating profit expectations of lower revenue and operating profit for Alibaba in fiscal year Q1 2022 due to slower growth in gross merchandise value. Why it matters: the world's largest e-commerce company in terms of gross merchandise volume had last year found itself under intense regulatory scrutiny after Alibaba's founder Jack Ma's criticism of the China regulatory system. The cloud unit is Alibaba's second biggest revenue driver after its core e-commerce business. In 2020, Alibaba's cloud business at the third spot generated $6.12 billion in revenue behind Amazon Web Services and Microsoft's Azure. So that's that. So yeah, all of that is known, but there are a couple analysts now starting to sniff it out and saying maybe the worst is behind us. Now I want to get back to, if you remember the famous article on September 24th, 2020, when I was pounding the table on Wells Fargo, and the article was called the Cobra Kai Sweep the Leg Stock Market and Sentiment Results. Cobra Kai was really big on Netflix. It's a remake of The Karate Kid, and when they're all grown up. And I was showing, in the movie, they have this thing. You're not going to be able to hear this, but maybe you can hear it.
Sweep the leg.
The coach says, sweep the leg.
You have a problem with that?
And then you see him go out there. And anyway, so he sweeps the leg. And that's basically what happened to Wells Fargo when I wrote this article. So we're bullish. It was building this base. It took like 6 months. But we were just like, look, this thing's trading at a 50% discount to book. It's only done this 2 other times in history. Book was about $40 a share. And we thought that this was a final leg sweep where they would take everyone out. And the sentiment model that we were using, because sentiment had gotten so low, $22.83, it then went up to $47 or $48, and then we started saying these things are going to pull back because all the late money was getting excited. Everyone that hated it and was making fun of it on the major stations in the 20s loved it up here and couldn't buy enough. The turnaround story is real, yada, yada, yada. And that's when we were like, we're lightening up. We know this is going higher over the next 3 years, but we're going to take a little off here. And sure enough, it's pulled back to the mid to low 40s. And we're going to talk a little bit about banks and how we're thinking about them short term as well, now that they have done the pullback we were anticipating. Now, this is the model. This is from Justin Mammis. I don't really know who that is, but this sentiment chart has circulated for years and years. And I found it to be very, very useful when you have a good quality business that you know what you own, trading in a period of dislocation and how sentiment works. So we used this in this article we said, patience, Danielson, you must learn to hold, because our basis was 25 and it went to 22. So it showed this model. So this is when you have absolute enthusiasm, then you have the subtle warning and disbelief, then you get the crash and you get the panic low. Let me make sure that you guys can see this. Okay. Let me just make sure that this is coming in. Yeah, okay, great. So you can see the whole thing. Perfect. All right. So then you get this panic low, and then you really screw them over, and you get discouragement down here. Then you get this rally to anxiety. Then you get the pullback again to aversion, and that's what we were in. We were in aversion, and they even sweep the leg down here, and then it took off, and what happened? It went up to $46, $47 over the next few months. Look at what's happening with Alibaba. It's following the exact same pattern, and I'm so happy I thought of this today because the timing couldn't be more appropriate. So let's go through this sentiment cycle because nothing has changed in the underlying business, and we just went through all the regulatory stuff and why it's in their interest and how they're now changing their languaging, and the market will catch on. Look at this pattern. It's exactly the same. Returning confidence was up here in September of last year. Then you get enthusiasm came in October, November of last year. And then you get this crash. It's exactly the same into panic. And then you get the anxiety up here. And then you get this aversion. And that's where we are. We're at this sweep the leg, just like we had with Wells Fargo in the article here. This was the sweep leg, aversion, sweep the, this becomes aversion, sweep the leg, and then you take off. And we're getting a similar pattern now. You got maximum despondency. Maybe there'll be a little more weakness, I don't know. But it's really looking a whole lot. It blows through this volume by price here. Did the same thing with Wells Fargo. It gets below this, so people start to panic. Oh, there's no one to support it. It blew through where all the volume is, and they couldn't defend it. It's toast. It's going to zero. And that's exactly what's happening here. And we'll see if we start to get that base filling in, and then a recovery to intrinsic value over time, just as we had pounded the table on Wells Fargo. But I just, this is exactly where we are, which would imply that as we get back up to anxiety, which is this level here, that's where you're going to face some of this pullback stuff. So once we get this base in, which, may chop around here, up and down again, scare, but this may be it, because we kind of got this pullback here. At the end of the day, if you look at the business 3 years out, and when all this noise subsides, this business is going to be at least double, if not a lot more. And that's irrespective of demographic headwinds, because they have international growth in Asia, and that can continue so long as the government doesn't destroy it for them. And I don't think they want to do that because they want to stay in power like every politician around the world. That is universal. So we're eager to see this thing move from aversion to anxiety, and then finally to returning confidence and beyond. And we'll just track this over the months to come. But it was pretty exciting to see, because it was the same kind of feeling in Wells Fargo when I did that leg sweep article as we're having with Alibaba today, when no one wants to touch them with the 10-foot pole. Just to follow up on Splunk, because we were pounding the table. If you remember, after earnings, they collapsed, and we said we were adding here. This thing has moved up, 30% in a few weeks. It's obviously going to pull back and consolidate those gains and probably scare some of the new money that just bought up here out. So just expect weakness in that. Maybe we get lucky and it pushes straight up to 175, but I think it's going to take a little time to digest that kind of move so quickly. The National Association of Active Investment Managers, they did pull back over the last week, so that's kind of a neutral thing there. I just wanted to update it from the article. Michael Santoli over at CNBC put out this chart from JP Morgan today. This shows the extreme in bonds. I always assume it mostly means funds are underweight duration. JP Morgan supports the general notion of bearish positioning. So everyone was short bonds. We said that when we were 3 weeks ago that we expected that yields would go down in the short term before rising and approaching 2% towards the end of the year, early next year, as the tapering becomes more imminent. And in the short term, they wouldn't be doing the tapering. Nothing's changed in our view. So far, that's playing out correctly, and it just showed how crowded this short bonds trade got at the exact wrong time, which is always the case. This is macro charts. Everyone with a foot out of the door. He's been pounding the table on this. I love this. Today's low tick tied for the fourth lowest in history in 31 years. This is just a measure of extremes. Prior extremes mark capitulation selling, which we may have saw today. Certainly, I would hope in some of these Chinese stocks. Stocks had minimal further losses and bottomed within 0 to 2 days. All but one record spike came in the last year. Is this time different? So this is this spike in the tick. This was the last time. You see here was a bottom. All of these kind of point to bottoms here. Bottom at these levels. Bottom here, June of last year. And you didn't even get this low during the pandemic bottom. So this should be interesting to follow in the coming days. Now, what did we talk about 3 weeks ago? We were going to get a pullback because everyone was jumping on the bandwagons in banks and energies. What have we gotten in the last few weeks? We've gotten the pullback. Citi. The question is, have we gotten enough pullback? And we're going to find out early next week because we got bank earnings. We lightened up on our Wells Fargo when we were talking about that, but we still have the majority of our position, our core position, and it just hasn't got down low enough where I want to add back to the whole position because we have enough that if it took off, we're perfectly fine. What area would I start to add back a full 100% position? I'm not sure. I could see people panicking in the high 30s. That's when I'd probably consider adding back because we liquidated about 46, 47, so maybe 38 we would add back some. But I look at like Citigroup and I almost want to buy it here. I mean, so these are kind of interesting, but they're not, this is not what I do. I'm not playing for 20% moves here. I mean, when something is just a softball down the middle, when it's down at a 50% to book, I load up the boat, and it was our biggest position ever. And this was, by the way, this is what happened after that leg sweep, by the way. So, and you can see it took a few more weeks after that article to bottom and then rocket. So maybe Baba will follow that same pattern. But here was the end result. And so we'll keep our eyes. We're kind of agnostic here. I mean, we still like the banks in the long term. Have they pulled back enough for us to want to buy more? No, we have enough exposure. We're okay. Energy, same exact thing I said. I thought the catalyst would be an announcement of the Rand deal. In the short term, it's been this OPEC stuff going on. This kind of buy the rumor, sell the news. But again, these are not levels, is the pain behind us? I think this probably has more to go because people got a little too excited about energy after hating it so much. So, and this is a huge move. So I think you start to scare people on Exxon around 55. They start to puke out and panic, maybe Schlumberger. I mean, some of these, if you look 3 to 5 years out, you could buy them all here. But again, I'm a buyer at these levels. We were pitching these before the election. This was a no-brainer at $35. At $60, it's a lot more complicated decision. So we have our core positions. We've trimmed back a lot on both of these. But we have enough that if they took off, we'd be perfectly happy. But again, if you look at these weeklies, they're starting to take out the late money, but I think there's still some room to punish people that came in too late. So, and that's what the market likes to do. Now, on the flip side, what else did we say is that we thought we'd start to see a second leg in some of these favored utility staples. We wanted to be in defensives and tech for the summer. That was our thesis. And let's just put a weekly thing so you can get a feel. So again, we put out the article February 24th, followed by I think March 6th. That's when they made a bottom. They rocketed off. Then they've been consolidating. Now you see here, we've been looking for this second leg higher. You're seeing it in Dominion. Our two biggest are Dominion and American Electric Power. Where's AEP? Same thing. Okay, so it put in the bottom 2 weeks ago. It's starting to build that second leg. So all these things are coming to play in line with what we thought would happen in the short term with rates. So we're very happy to see this stuff starting to play. And you can see on a daily, these are starting to be bigger moves off the bottoms here. So American Electric Power, so it's moved up $4. Dominion's up a couple bucks in the last couple of weeks. So they're all starting to bounce now, exactly in line with the rates. Same thing with some of the staples, okay? So these, you couldn't give them away 2 weeks ago. And, again, they took off. Here's Colgate-Palmolive, took off after March, pulled back to consolidate. It's starting to move up again. Clorox is starting to move, finally. Procter & Gamble, same thing. Kimberly-Clark is up $7 in the last couple of weeks. So, these are all starting to move. These are defensive groups that do well when the market's choppy, when rates are low, and we're seeing that takeoff happen. So we're excited to see that. And then these are some of the big drug stocks. Again, let's just take a look here. So Novartis is a key one. It took off from the late February, early March. It consolidated the last few weeks. And now if we look on a daily, it's starting to pick back up. Pfizer has just been going sideways. We'll see what happens over the next week or so. Pfizer had made that huge move, consolidating. Same move as Novartis. These are our biggest two. And now we expect a second leg for both of these. And I think we're seeing signs of it, J&J. So these are the big pharma companies, and we're seeing them start to get bid. Why? Because they're defensives. And when rates are low, the yields of staples, utilities, and pharma become that time much more valuable because they're now in most cases 2 times that of the 10-year yield. Here's a 10-year note. This is interesting to interpret. We've talked about the commercial commitments of traders. They're often aggressive buyers ahead of bottoms, aggressive buyers ahead of short-term bottoms. And so they've been buying in recent weeks, and sure enough, we got a bounce. Whether this is the bottom, and, I think this is kind of a counter-trend move. And in the scheme of things, it hasn't really been a big move up or a big move down. So if you look at historic rollovers, you get these counter-trend moves, and then you get rollover, which would mean bonds down, yields up. Same thing, even if you assume we're here, it's a counter-trend move until you finally, it takes a little time to build a base. So my guess is at some point in weeks or months, as I had said, short-term, bonds up, rates down. We got that. Maybe we get a little more intermediate term towards the end of the year. This probably, rolls back over, and I don't know if it bottoms here or here with yields closer to 2% is probably the target. And you see this type of thing over and over. You don't form a bottom overnight. You get these counter trend things on the way down. So how far down it goes and how high yields go, that will depend on the timing and temperament of tapering, which doesn't start till next year. So just wanted to... Now, mortgage applications are stuck at May 2020 levels. By the way, for those of you on the podcast, we have so much to cover this week because so much has happened. You're going to get cut off in a minute and a half. Go to hedgefundtips.com, click on the VideoCast. It'll be the first thing that comes up. And then fast forward to minute 60 on the YouTube video, and you'll pick up word for word where you got cut off, and you'll get the last 10 minutes. We're covering a whole new thesis on mortgage lenders, and you're not going to want to miss it, so take advantage of that. For those of you on the VideoCast, let's move forward. Okay, so mortgage applications are stuck at May 2020 levels. Here's why. The number one reason why is because of the mismatch between home supply and demand. There's not enough supply on the market, and with commodity prices rolling over in the last month and lumber collapsing its biggest drop, 1 month drop in 40 years, we're going to start to see supply come back, and it's going to come back quickly and aggressively. The other thing that's happening as it relates to that is mortgage rates are going down, so that's also going to spur demand, people who felt that they missed it. So that's good. Lowest since February of earlier this year. 30 years at 2.9. And then the Fed meeting, this is just a review. They were divided over inflation risk and bond buying when they met in June. This is from the Fed minutes that were released this week. And basically, what they said, the net effect was they weighed all the risk, and they're going to stay dovish. That's really, and that's going to help demand for housing. Then today, after I put out the article of the week, Telus Demos posted an article. He said that now may be a good time to buy mortgage stocks, and he points to mortgage application was at its lowest level last week since January of last year. Mortgage executives. The bigger picture doesn't look quite so grim. Rates have continued to trend lower. More buyers might eventually capitulate to higher prices as strong wage growth paired with historically low rates make monthly payments relatively affordable. And then he points to UWMC, which we talked about on Fox Business last Friday, and Rocket Mortgages. What he's pointing to are the two key arguments in our article of the week, which are that the Biden administration is likely to put in policies to widen access to home ownership, and that means that's code for they're going to lower lending standards once again, as they did in the early 2000s, which led to the last housing boom and bust. So more likely than not, the new overseer of Fannie and Freddie will keep them under conservatorship versus privatizing them as the previous administration wanted to do, in which case they will be able to lower lending standards. And the biggest beneficiaries are those that originate qualified mortgages that are sold to the GSEs, Fannie Mae and Freddie Mac. And the biggest originators of the qualified mortgages, you've got your Rocket, you've got your UWMC, United Wholesale Mortgage Corp, and your Loan Depot. And that's the basket we're going to talk about. The other thing that Biden's doing, in addition to likely having, Fannie and Freddie will stay under the government's thumb, which will enable them to lower lending standards, which will have many more people qualify for mortgages, and you'll start to see less income verification and more people being able to get in homes. Standards are still very, very strict right now. You still need a 20% down in most cases, unless it's some type of special FHA or VA type of thing. So you're going to start to see something in between what you saw in 2006 and what you're seeing today. Today being the most strict it's been, 2006 being the loosest it's ever been. So you'll get something in the middle of that. And the other thing that he's doing, Biden's infrastructure plan seeks to erase housing shortage with looser zoning rules. The program of at least $5 billion would offer grants to cities and towns that relax restrictions on new construction. Push to increase the supply of affordable housing aims to coax states and localities into easing restrictions on new construction. A bid to help address the historic shortage of new housing. Roughly $213 billion of affordable housing initiative in the $2.3 trillion infrastructure plan includes a competitive grant program to target so-called exclusionary zoning laws that the administration says have inflated housing and construction costs and locked families out of areas with more opportunities. A grant program will be at least $5 billion, according to an administration official. And in our article, we're going to go into what that means. I mean, if you look at the supply of, so this was from Freddie Mac, I think, or Fannie Mae. Let's just see. Freddie Mac, okay, put out this research. So all these white and green charts in my thing are from Freddie Mac. And if you just look at the number of new homes constructed below 1,400 square feet, entry-level home construction collapsed after the Great Recession That's right here, and it never recovered. So all the building that you've been seeing are like high-end things for the last 10 years, and where's the demand? If you look at demographics, is in the entry level, right here. These are the 30-year-olds. This is the biggest part of our demographic. This is what gives America such a huge demographic tailwind. China's demographics look nothing like this. It's fattest at the top, like Japan was in 1989. Ours is fattest at the bottom, where housing formation is beginning, and we're bigger than even the baby boomers, which drove the bus from 1982 to 2000, and their parents from 1948 to 1966, two of our previous biggest booms in history. And right now we're probably halfway through our third biggest boom in history, and we probably got another 8 or 10 years to go based on this huge demographic tailwind that we have. But these folks aren't buying $3 million houses at age 30. They need these Levittowns of the world, 1,400 square foot. And look at here. This is when the boomers were getting going. And guess what home builders did? They built for them, and they put a ton of that supply in the early 80s when the boomers were at this age. Just do the math, okay? And they were starting housing formation. And now with exurbs, with a 5-hour work week being less mandatory and having more hybrid where you can be in 2 or 3 days a week and work, 1 or 2 days or 3 days a week remotely, the exurbs where all the land is where you're going to see these tracts of supply like Levittown after World War II, with, thousands of these tiny houses, starter houses, and hopefully we'll see this 1,400 square foot supply rocket up because they can make a fortune on that, and people can afford it. So the key is, if you think about it, it's like, oh, well, my kid can't afford to get a house, housing prices are high. Well, your kid is trying to buy a house that's double the size of your starter home. For most baby boomers, their starter homes were like $1,200 or $1,500 on a slab ranch or whatever it was. And there's just not enough supply of that. So that's going to come back in spades, and it's going to come back quickly with supply costs collapsing, lumber and that in the last few months, and demand going crazy and rates going lower. Everything's set up, and most importantly is this huge demographic that needs it. So then you're saying, well, then why don't you just buy the home builders? And we're going to get into that. The crux of this idea came from, I was asked to be on Fox Business on Friday to talk about the jobs report. They added 850,000 jobs, but the number of employed people increased from 9.3 million to 9.5. The job quitters grew 164,000, which is why you saw the unemployment rate tick up to 5.9 from 5.8. And the long-term unemployed, U6, also increased another 233,000. So there which is not counted in the regular unemployment rate, to 4 million. So we got 9.5 million people we still need to put back to work, which means the Fed is going to stay easy. And they're going to do that until we get probably halfway between where we were at 5.7 million unemployed before the pandemic, and 9.5. So figure somewhere in the sevens. When we hit that, taper will start, and then the conversation about rate rises will start. So what I said was, after 90% push off the pandemic lows, are there any bargains left? And I said, yes, a derivative trade on housing is our latest target. The key factor in housing demand is improving jobs market, which we saw with 850,000 new jobs. It's also, more importantly, the 72 million millennials near age 30 in the midst of housing formation. Demand for mortgages will persist in the next few years. And then finally is the Supreme Court decision, which gave the Biden administration power over Fannie and Freddie, and allowed them to continue to basically impound the profits from these GSEs and right to the Treasury and screw the shareholders, more or less. And he will be putting, there's an interim person, he'll be putting in a new new chief overseer, and it's consensus that the lending standards are going to loosen, and the originators of the qualified mortgages rocket United Wholesale Mortgage Corporation and Loan Depot will be the biggest beneficiaries. They're all trading at single-digit multiples, more or less. I mean, Rocket's trading at 11.8 times next year's earnings. Loan Depot's trading at 4.75 times next year, and United Wholesale's trading at 9.3. So why are these in the gutter? If there's so many people that need houses and, it's going to be rainbows and unicorns, then what is the market seeing that you're not, Tom? Well, what the market's seeing is that last year was historic high demand for refinancing and origination, but predominantly refinancing was enormous. You can just see the numbers here. Was just off the charts last year, and they feel that that's going to collapse. But what's embedded in their assumption is that rates are going to dramatically increase quickly. And that may or may not come to pass. This was put out in March, and I think that assumption is wrong, because if you had asked Fannie and Freddie about their outlook for rates in March, it would have been much different than they are right now, because if you recall, we'd just come off a period where the 10-year went from 50 basis points to 175 basis points in a matter of a couple of few months. So I think these assumptions are wrong on the refinances, and I think they're definitely wrong on the originations, which they're assuming are, go up this year and next relative to last year, but only about 20%. Whereas they have originations, refinancings collapsing by 80%, and I simply don't think that's going to be the case. I think that both of these are going to go up much more dramatically than anticipated. I don't think we'll hit 2020 refinancing levels in out years, but I do think there will be pockets where this number is closer to having a 2 in front of it than what they're showing in this table. That's number one. Number two is all that's priced in by these multiples. So these are assuming the worst case scenario that Freddie has put out. And if you look at supply is going to come back aggressively at that entry level, just like it did for the boomers in the 80s and their parents in the 50s. Think Levittown and everything else. So this is the monthly supply of houses in the United States. Obviously, just a huge dearth. It looks like about 5 months supply relative to the peak. There was 12 months supply. And, in the 80s, meeting that boomer demand, it had to get up to 11 months supply. So we're nowhere even half of the way there. Privately owned housing units authorized in permit issuing places. So permits are climbing out of the great financial crisis, but again, nowhere near the peak. Plus the population's gotten bigger. Same thing with new privately owned housing units. Housing starts are all the way back to, 1998 levels. So they haven't been this, this is, and again, the most important factor is this: you've never had this. So you're saying, well, will it get back to the peak? It's got to go far past the peak, because if you think about the early 80s, the demand was even smaller. So now it's bigger, and they're starting later, and they just got to create more of these Levittowns with these 1,400 square foot, or maybe 1,600 square foot if they can do it smart. People are a little bigger these days. But that's the name of the game. We're going to see a number of new homes constructed below 1,400 square feet. We got to see this probably get back into the early 80s levels, and we're nowhere. We're 1/10 of that right now, basically, if you look back, and that's where the demand is. So there are still bargains. You just have to look harder to find them, like Wells Fargo and energy trades last year and Alibaba in the past month. It'll take some time and short-term bumpiness for these to form a solid bottom and finally take off, but we think the risk-reward has become compelling as a basket of UWMC, LDI, and RKT. Again, this is our opinion, not advice. We don't know your situation. See terms. We're still in the early days of the other thing, as a reminder for new readers, financials and lenders, that's this green line, continue to do well after the initial flattening of the yield curve until inversion. We're still in the early days of steepening despite the short-term counter-trend move, and have some time to run until the flattening process begins. The red line is the ratio of the 10-year Treasury yield to the 2-year Treasury yield. If anything, rising rates spurs buyers off the sidelines to finally take action, as we saw in 2003 to 2005. So in 2003 to 2005, as the housing market was going crazy, rates were going up at the same time. So people who say that rates go up is going to kill the housing thing, it's not the case. But I don't think rates are going to go up as aggressively as people had anticipated. Now, let me just walk you through this. This was the inversion in August 2019, which presaged the recession in 2020. The last time we had that inversion was in 2007, which presaged the recession in 2009. And then we had that in 2000, which presaged the recession in the early 2000s. So what happens after a recession? The Fed steepens the yield curve to get credit flowing. We got that in the early 2000s. We got that after 2009, and we just got that now after last year's recession. And what happens every single time after the initial steepening? You get a huge counter-trend move, flattening, huge counter-trend move, flattening. Then it steepens again, then it flattens. But even after it starts to flatten, which we're just starting this steepening process, by the way. This usually takes a couple years, this steepening process, 2, 3, 4 years. We're just in the first year, so we're going to be steep for a while. But even as it flattens and starts to roll over to inversion, which means the 2-year yield and the 10-year yield converge, and net interest margin goes down for banks, the financials continue to go up until that inversion. Same thing here. The yield curve was flattening for all of these years, and financials continued to go up until it finally inverted, and that's when financials rolled over. So that's that. And as far as the originators, they get a lot of interest when rates come down in the short term. So all the factors are there, but the most important factor for everything, whether it's China or U.S. or everything, is this bubble in the U.S., which is bullish for the next 10 years. Housing formation drives everything, and China doesn't have it. They just figured that out, so that's why they're saying, please, everyone have babies. But they're too late. So that's going to take 10, 20 years for that to kick in if they haven't changed people's habits permanently. My bet is within the next 20 to 24 months, you're going to see the Chinese government start paying people $20,000 and $30,000 a kid to make a baby. I mean, that's really where it's going to come down to. If they truly understand the implications of demographics and what happened to Japan, that's how they'll save themselves. Number one, ease off your best companies and stop trying to kill them. And two, have people have more babies or find a way to get immigration. But more likely, it's going to be incentivize people to have babies so they don't fall into the Japan trap and be stuck in that for 3 decades. Okay, so fear and greed came in at 39. There's still some fear in the market. National Association of Active Investment Managers, again, it's kind of neutral in this. My guess is this dropped down to the 60s after today. They probably all puked out this morning. We'll see that in next week's read. And then our message for the week. I'm going to read through this because there's a lot in here, and then we'll wrap it up. But we did have a lot to cover because a lot's happened in a very short period of time. So with Q2 earnings season coming up in the next week, expectations are high. Consensus is that the S&P grew earnings by about 63% year on year. The good news is that number will likely be beaten and come in at 70% in my opinion. The bad news is you're going to start hearing peak growth. Remember those 2 words every time you turn on the TV in the coming weeks and months. That may help keep rates subdued in the short term over the summer. That's why we like selective tech and defensives, utility staples, and pharma. We've been saying that for the last 3 weeks. We believe that's where the opportunity is right now for summer, as cyclicals will likely continue to shake out some of the late money in coming months. We covered that in energy and banks. Let's see how bank earnings do next week and energy the week after. Before resuming their uptrend and new highs later in the year, we're still at early stages of new business cycles, so longer term, banks and energy, thumbs up. We're using this week's volatility in Chinese stocks to add to BABA. We added in mass today. The fundamentals of the business have not changed, just the noise coming out of Beijing. That's why it's important, not to know the price of everything, but to know the value of everything. And we know what the intrinsic value is of BABA, and that's why we're adding into weakness. Our view is that at some point the Chinese government will stop shooting itself in the foot. If it aspires to become a true economic superpower, it must compete globally. Handicapping and finding their largest, best performing companies will put them at a competitive disadvantage and begin to limit their access to global capital markets. If this behavior continues, the Chinese government may retain the control they desire domestically, but materially diminish their power, influence, and stature globally, which they don't want. My bet is that cooler heads will prevail as sooner or later people do what's in their best interest. Unfortunately, and I think Churchill said this, I think he said it in reference to America, he said, sometimes the correct decisions come only after they've exhausted all other options. I think the quote was, America always makes the right decision after exhausting all other options. We hope this is not the case with the Chinese government's posture toward the best Chinese enterprises, as it will set them back perhaps irreparably. Once the world's deepest and robust capital markets close to you, it takes years for those doors to reopen, if ever. And that will cost them tens or hundreds of thousands of jobs if our capital markets close to them. And that threatens their government control over the populace. So they don't want that. And I don't think they're going to put themselves in that situation if they reverse course quickly enough. Of note, just this morning, the headline hit that China's central bank would ease policy and stimulate the economy with cuts to the amount of funds banks need to hold in reserve. This has the market concerned that China's growth may be slower than anticipated. While the market is taking this as bad news in the short term, it is actually good news in the intermediate term. China started tightening policy prematurely 6 months ago, hoping they could piggyback and free ride on the easy monetary and fiscal policies in the West. I repeatedly said on my appearances on CGT and America, you can click here if you want to find them, that this premature tightening in the middle of the pandemic would come back to bite them. They have now realized their error and started to correct it. That is good news. The question now is whether they will realize that now is not the time for the regulatory rigidity that they have displayed with their fastest growing tech platforms and foreign listings. If they don't change their stance soon, the capital markets will do it for them by shutting down to Chinese companies. Having shown the flexibility to correct their economic policy errors this morning, we are hopeful they will correct their regulatory rigidity and timing errors as well as it relates to their big internet companies. And to note, it's always darkest before dawn. That's the leg sweep. This is where everyone puked out. It didn't hold the lows. So what? We know what the intrinsic value is. Could the government do something crazy, stupid, and really hurt the stock in the long term? Yes. Are the odds with that? Everything in life is a probability, and you got to take your swings when the probabilities favor rational outcomes, and the rational outcome is an intrinsic value in the intermediate term of $300, and in the long term, this is the next Amazon. It could be unlimited. So that's that. And some unusual options activity again in the China-related stocks this week. Las Vegas Sands, 5,000 contracts. We like that. Baba came in today. Someone came in at 200 March of next year, 200 calls, did 1,300 contracts at $24 a contract. So, there's some smart people starting to get involved. Earnings estimates went up again last week, so that's a good thing. And then as far as economic data, ISM non-manufacturing was light this week, so we'll keep our eyes on that. You're going to see more of this peak growth narrative, which will keep rates low, help our defensives over the summer. And then cyclicals will come back at the end of the year. Same with non-manufacturing PMI missed. Jolts came in at 9.2 million still. Huge draw in oil, so you got a little bit on that. But again, keep your eye out for that Iran deal. And then that's it on the economic data. And then earnings next week. Tuesday starts with JP Morgan, Goldman Sachs. And Wednesday you get Bank of America, Wells Fargo, and Citi. So that's the big story for next week. That's what we want to watch out for. A few industrials, Honeywell at the end of the week. And you'll see Taiwan Semiconductor and Healthcare United Health you'll see on Thursday. So some Dow components, and that'll give us some color as to not just the beat rate, but more importantly, the guidance moving forward. So with that said, we covered a lot this week, but there was a lot to cover. And want to thank you for listening in. We'll be back next week. In the meantime, make it a great one. Bye for now.